Hello, my people. Nice to be here again. In some previous videos, I've been treating the topic, the theory of capital structure and financial leverage, where I said that leverage can be synonymous used as what? As gearing. So when you hear the word gearing, we are also talking about leverage. Having said that, now said, if a company has an element of debt in its capital structure, it means the company is geared. So to now know the rate of geared or how geared the company is, that will not depend on how much debt, what is the ratio of the debt to the company's equity, to the company's value of the value of the company, and the various that is where we measure. When I gave out the formulas, which were termed as what? The various levels of gearing. So if the gearing is high, you say the company is highly geared. If the gearing level is low, that is, an element of the debt in the company capital structure is not as significant or is not as much as that, we say the company is low geared. There's no debt at all, the company is not geared. Having said that, we have different schools of thought, which are school of theories, which we term as theories under the capital structure. There is a traditional theory which says there is an optimal level of gearing that the company must have in its capital structure, that anything above that level, the company will either be devaluated, that is, the company is going to lose its value. Well, the school of thought, the M&M theory, stated that it doesn't matter the level of gearing of the company, that what is determined is what is the value of the asset of the company and not the capital structure. What determines the value of the company is the asset of the company and not the capital structure of the company. So M&M went further to postulate a situation whereby there is tax and where there is no tax. So the value of the company, where there is no tax, will be the same at any level of gearing. But when there is tax, it will definitely have effect on the company. I've treated all these in my previous videos, so you can just search for it, scroll down and see these videos I'm talking about. So today I'm going to look at M&M theory of arbitrage. So what is arbitrage? What did M&M said about arbitrage? Let's look at it. So the principle of arbitrage was proposed by M&M in their theory. M&M means Modigliani and Miller. Those are the people that propounded the theory. So this is named after them. That's what we call M&M theory. Was proposed by M&M in their theory to justify their case. M&M demonstrated that if two companies have the same annual earnings and are also subject to the same business risk but do not have the same market value purely because of the difference in their capital structure, then investors could make profit by selling their shares in a company that has the higher market values and buy shares in the company with the lower market value. So what is arbitrage process therefore? Arbitrage process therefore is a situation where shareholders can switch between two firms that are identical in all respects except their degree of leverage. So what does that mean? This simply means that if one of the firms had a higher market value than the other, the shareholders of the higher firm, of the higher value firm, will sell their shares and buy those of the lower value company until the share price of both firms until the share price of both firms are the same. So what arbitrage is trying to say is that switching from one company to another in order to take advantage of what, of the difference in prices of what, of the two companies. So M&M has proposed this theory to justify their case when they talked about the issue of the issue of what, of the value of the company. So based on arbitrage profit advantage, a rational investor will restore to arbitrage by switching from a higher value firm to a lower value firm. It should be noted that an investor could switch from a geared company to an ungeared company and vice versa, according to M&M principle. M&M concluded that the capital structure of a firm does not matter because whatever the financing mix adopted, the market value of the two firms will be the same. So M&M is still of the opinion that the level of gearing of a company or the mix of what, of the capital structure of a company does not really matter because at the end of the day, the value of the two companies will be the same. So that is to say, we are not talking about arbitrage in this case, whereby we have investors. If what it's saying is that for investors that investor can easily switch from one firm to another firm, if one of the firm has what, a higher market value, it can then test to do what, to buy the shares of the market of the, it can test to do what, to sell its shares in a company that has higher market value, and do what, to purchase. So by implication, the company that has the higher market value, the work of the company will be what? Will be at a minimum. So by that, therefore, we now sold his shares in the company with higher market value. He can then do what? He can then proceed and buy the shares in what? In a company that has what? A low market value, in which what? The return, the work of such company is what? Is very high. So it's vice versa. So by that, therefore, the investors can make an arbitrage profit by switching from one firm to another. By switching from what? From the other value to what? The firm that has the lower work. So by that, therefore, it's going to do what? Make an arbitrage profit. That is what M&M is trying to explain here. That's exactly what M&M is trying to. Both of them are trying to stress in this case. So having said that, there are some solution steps, there are some procedures that needs to be followed when you are solving question under arbitrage. A solving question under arbitrage. Let me quickly give us the solution steps that needs to be followed when you are talking about arbitrage. arbitrage. So procedures. Cost of equity. Okay. Okay. Now, this is the solution procedure for solving arbitrary problems. Number one is what? Draw up the two companies' capital structure using the market value. So that is, you want to solve a question that involves arbitrary, that is switching from one company, one firm to the other, by an investor. These are the procedures for you to follow in order to arrive to make your recommendation at the end of the day, whether it should switch or not. So we are doing this in order for us to determine whether the investor should switch from that company A to company B. So these are the procedures for you to use to do or to solve a question involving arbitrage. So the first one is to draw up the two companies' capital structure using the market value. Apply the earnings before interest and tax for the two companies and deduct the interest and tax, if any. That is your solution. So you now start from this. All this one is saying is that apply the earnings before interest and tax. So you pick your earnings before interest and tax. If for the two companies, if there is what? Interest and tax in the question, you have to do what? You have to adjust for it. So you deduct your interest and at the same time you deduct your tax element. So solution step 3 is what? Calculate the cost of equity capital. Cost of equity capital, which we have learned under our cost of capital, where we have the formula K is equal to D0 over D over MV, where there is no growth. And the formulas we have, we have treated this topic, cost of equity, cost of capital under, we have treated cost of equity under cost of capital anyway. So calculate the cost of equity capital, cost of debt capital, and WACC for both companies. Solution step 4 is what? Compute the current income earned by the investor in the higher value company before switching over. So you have to determine, that solution step 4 is that you have to determine the current income earned by the investor before trying to do or to switch over, in order to determine its current earnings. So you now compare that to what you are going to have at the end of the day. So compute the total, number 5 says, well, compute the total value of investment in both equity and debt of the investor. Solution step 6 says what? Use the total value of the investment to determine the prospective investor's income from the lower valued firm. 6 again says, well, use the total value of the investment to determine the prospective investor income from the lower valued firm. Of course, so after you have done that, so next step for you to take is what? Deduct the interest payable on the borrowed fund from the investor's total income. So the interest payable, you have to deduct it in order for you to know is income. So because of space constraint, let me rub this one, and you still have other steps for us to follow in order to arrive at to make our decision. So please, I need to rub this now in order to incorporate step 8, because we have step 8, 9, and 10. So let me rub from here. We already have this. A quick one, please. So 8. From here, okay. So this is the concluding part of the solution steps that we have for solving question under arbitrage. This is the concluding part. This is the concluding part of it. So number 8 says that compare the income received by the investor from the higher valued firm to the income received from the lower valued firm. Here, the investor is switching from one firm to the other. So now say compare the income received by the investor from the higher valued firm to the income received from the lower valued firm. This difference definitely be compared, there will be difference between the two. This difference represents either gain or loss on switching investments. So just step 9 says what? Compute the equilibrium market price at which no gain on switching. So then stands to do what? To find what? The equilibrium price at which there is no gain on switching from one point to the other, from a company to the other, from one company to the other. So just 10 steps says what? Compute the two companies' work, which must be the same. So therefore, here, if you have compute what? A market value, an equivalent market value, that is where they now become one, the same, where they become the same. So therefore, at that point, the company's work of the two companies the two companies work will be or will be the same. So these are the solution steps to do or to adopt. These are the procedures to follow when we are talking about what? When we are talking about solving question on question that involve what? Arbitrage. At this point, I'm going to call it a class now. I will say that the solution steps in some of my subsequent video, in some of our subsequent video, I'm going to compute some questions that involve arbitrary. So from there, you're going to appreciate all these procedures I've given better, so in order to see how we're going to do what, apply all these procedures. So at this point, I'm going to call it a class now. It's my pleasure listening. It's my pleasure communicating to you today. I'm very glad to see you or to see you watch this video and listen to this video. So thank you for watching, and God bless till I see you next week. Don't forget, if you have not subscribed to this YouTube channel, kindly click on the subscribe button and subscribe to the channel. It's costing nothing, just a click on the subscribe button and you are subscribed. And give the video a thumb up. And if you have any comments, you have it in the comment section, kindly put it in your comment there. And I'm very glad to do or to respond to your comment. At this point, we're going to call it a class. So I see you next in my next video. Thank you very much and God bless. Bye.